We all know that refinancing your mortgage could save you thousands every year. For example, refinancing a $400,000 loan from 6 to 4% interest could save you $488 a month on a 30-year term. That's almost $6,000 annually. But today I'm going to show you how to do it, because if you mess up your refinance, it could end up costing you just as much as you could have saved. I'm David Zai, and in this refinancing masterclass, we'll cover everything you need to know about refinancing, from Streamline options to calculating your break-even point and exploring alternatives like home equity lines of credit. If you're ready to make your mortgage work harder for you, let's dive in. Streamline Refinance is one of the most efficient ways to lower your interest rate or monthly payments, especially for government-backed loans. VA Streamline Refinances, also known as IRRRLs, interest rate reduction refinance loans, makes the process fast and easy. There's no need for income or employment verification. No appraisal is required. You can even borrow more than your current loan balance by rolling in your closing costs. Keep in mind, however, the VA has a very strict guideline for these interest rate reduction loans, and you have to be able to recoup your cost in at least 36 months. Now, FHA Streamline Refinances are another option, offering no appraisal or income verification. While FHA Streamlines require mortgage insurance premiums, they're a great choice for borrowers who might struggle to qualify for conventional loans. If you need to borrow above the current balance, lenders may ask for asset verification, but the overall process is significantly less burdensome than a traditional refinance. We talked about the streamlines. Let's talk about what a conventional refinance is, because they don't offer a rate reduction or a streamline. Conventional refinances, they don't have a streamline option, but they do offer substantial flexibility. You can eliminate private mortgage insurance if you've built up 20% equity in your home. You can also consolidate high interest debts, reducing your interest rate, or even shorten your loan term to save on interest over time. Conventional refinances are ideal for those looking to optimize their mortgage while retaining flexibility. There are many reasons to refinance your mortgage. You might lower your interest rate, reduce your monthly payment, eliminate private mortgage insurance, or access home equity for renovations, debt consolidation, shorten your loan term, or switch from an adjustable rate mortgage to a fixed rate mortgage for that stability. Each of these scenarios can provide significant financial benefits when done strategically. If your current mortgage rate is very low and you're hesitant to refinance, you should consider a home equity line of credit or a HELOC as an alternative. The home equity line of credit or HELOC allows you to access your home equity without altering your original mortgage terms. This is a great option for funding renovations, paying off smaller debts, or even investing. Keep in mind that home equity lines of credits or HELOCs come with very few downsides. You'll have two separate payments, and most HELOCs have adjustable rates that can increase over time. To make the right choice, you'll need to calculate your blended rate, which is a weighted average of the interest rates on your first mortgage and your HELOC. The blended rate is a weighted average of your interest rate on your first mortgage and HELOC. And here's how to calculate it. So step one, we're going to multiply each loan amount by its interest rate. So for example, on a $300,000 loan at 3%, it's $9,000. Then on the home equity line of credit or HELOC, it's $100,000 at 8%. So that's $8,000. Now step two, we will add the total interest cost together. So $9,000 on that first mortgage, and then $8,000 on the HELOC. And that gives us $17,000. From there, we will divide the total interest by the total loan amount. So $17,000 divided by $400,000, and that gives us a blended rate of 4.25%. When you're comparing the blended rate versus your refinance rate, if your blended rate is higher than the current refinance rate, refinancing your entire loan may make more sense. Conversely, if your first mortgage rate is really low, a home equity line of credit or HELOC could be the better option. Let's talk about cash out refinances now. Cash out refinances and the processes and steps that will allow you to access your home equity for cash while replacing your existing mortgage. And here's what you need to expect when you're doing it. So on a VA cash out refinance, you can borrow up to 100% of the home's value. But keep in mind, not every investor or lender out there allows you to do this, because there are loan level pricing adjustments on anything over 90% loan to value. And those loan level pricing adjustments are very high. So when you're going to that retail lender that's charging you $8,000 to $11,000 more over the life of the loan, they may tell you no. So it's really important that when you're shopping for these, you shop with a wholesale mortgage broker. Next, we have the FHA cash out refinance. It requires that you have at least 15% equity and includes upfront and monthly mortgage insurance. Yes, you did pay for this upfront. However, when you do the cash out refinance or even the Streamline, mortgage insurance will be required again, and it does require at least 15% equity. However, like I said, there's way more loan level pricing adjustments. So if you can keep it at the 20%, it will be better. And then on the conventional cash out refinances, they're typically gonna require at least 20% equity for the best terms. Now, the steps that you will take to refinance for that cash out refinance is number one, apply with your wholesale lender. Provide them with all of your income, asset, and liability and credit documents. From there, if you're okay with the terms, you'll then say, yes, I want to go through with the loan and order the appraisal right away. Appraisers can take up to 14 days to have the report back to us from the time that they accept it. However, what they do is they're not only going to determine your home's value and borrowing limit, but they'll also look at your property and say, hey, here are the safety, sanitary, and structural issues that may come up. And if it passes everything without any repairs needed, then you can borrow without any additional hurdles. The third step is going to be the approval and closing. This is where we have the appraisal, we have the title work, you've applied with us, and you provided all of the income, asset, and liability documents. And now we're going to get the file put together by processing and submit it into underwriting. Once everything is approved, funds are then dispersed at closing, and your new loan will replace the old one. Refinancing to lower rates can significantly reduce your monthly payments. So let's go over an example of a $400,000 loan. Let's compare it at 6% and 4% on a 30-year fixed mortgage. At 6%, the monthly payment is $2,398, and at 4%, the monthly payment drops to $1,910. The savings is $488 a month or $5,856 a year. Let's now compare a $400,000 loan at 6% on a 30-year fix versus a 4% 15-year fix for a faster payoff. The reason I gave you this scenario is I mentioned the average mortgage rate in the last 10-15 years has been right around that 6% mark. Let's just say you have that average rate. Hypothetically speaking, if the mortgage rates were to drop into the 4s, that 15-year will be a little lower than the 30-year. So we're making this comparison. On the 30-year fixed mortgage at 6%, the monthly payment is $2,398. So over 30 years or 360 months, when you're making that $2,398, the total payback is going to be $863,280 on principal and interest only. If you had that opportunity to refinance, let's just say at 4%, the monthly payment would go up to $2,958, and over 15 years or 180 months, your total repayment is going to be $532,440. So while the 15-year mortgage has a higher monthly payment of $560 more, it significantly reduces the total interest paid, resulting in a $330,840 savings over the life of the loan. Considerations that you have to keep in mind is if flexibility is important, you can opt for that 30-year mortgage and then make the additional principal payments to achieve a faster payoff. And this keeps your debt to income ratio lower and allows you to reduce your payment during months when your finances are a little more tight. Let's break down that refinance cost. Understanding cost is crucial to determining whether refinancing is worth it. In this example scenario, we're going to look at a current mortgage balance of $400,000. And let's just say your closing cost is 2.5% of the $400,000, and that equals $10,000. Your monthly savings is going to be about $488 a month if you're refinancing from that 6% to a 4% on a 30-year fixed mortgage. The break-even analysis is going to be calculated like this. We're going to take the $10,000 in closing costs and divide it by $488 a month, which is the monthly savings. And the break even is 20.5 months. You'll recoup your cost in about 21 months, making this refinance a smart financial move if you plan on staying in the home longer than that. Refinancing and HELOCs are powerful tools, but only when you use them strategically. Whether you're lowering your rate, consolidating debt, or accessing equity, the right decision can save you thousands. So click the link below to chat with my team or visit davidzimortgageguy.com to access calculators, tools, and personalized guidance. Don't forget to like this video, subscribe, and turn on the notifications for more expert tips on building wealth through smarter mortgage decisions. Let's make your mortgage work harder for you. I'm David Zy, Mortgage Guy, and I'm out.